We just heard from the finance secretary discussing the resiliency of bank deposits in the city and hot money flowing in with some big listings in the pipeline. What are you observing in terms of capital flows and what potentially could derail this resilience?
Well, that's absolutely correct. If we look at 25 years of history in Hong Kong, there's been rarely any incidents of mass capital outflow. That happened around 2008 during the financial crisis. But typically, Hong Kong's capital situation has been very, very strong, and banks have continued to see rising deposits. And that's what we're seeing right now, as I think Paul Chan just said. Recently, in the last couple of weeks, we've been seeing very substantial inflows of cash into Hong Kong, which has actually pushed the Hong Kong dollar to the strong end of the pegged relationship, which has meant that the finance gurus in Hong Kong have had to sell Hong Kong dollars to keep the pressure off the Hong Kong dollar from rising too high. So at the moment, we're seeing a net inflow of capital, not a net outflow. And that's largely due to the numbers of listings that are coming through in Hong Kong. We're seeing JD.com, a big Chinese company, NetEase, another China company listing in Hong Kong. So a lot of money is flowing in to hit those IPOs.
It would seem that authorities here in Hong Kong would like to keep up the momentum around big deals for the city. In an SEMP report citing an interview with the new Secretary for Financial Services and Treasury, Hong Kong is to relax its 14-day quarantine rule for executives of 480 of the largest companies listed here, including the likes of Tencent. Will we see more such measures to try and boost investor confidence against the political backdrop that perhaps could lend some uncertainty?
Yes, there's a long-term history of that in Hong Kong, where we've seen, for example, in the period leading up to the handover in 1997, there was a very significant opening up of liquidity from China into Hong Kong, which really supported the financial markets and the asset markets at that time. And one had the feeling that encouragement of capital flow was designed to make Hong Kong look good at the time of the handover, which was a time of considerable uncertainty. I suspect we may see a little bit of that this time around as well. And if we think about it, one of the big policy objectives of China is with the Greater Bay Area concept. This is a very high priority in China policy. And this, of course, does involve Hong Kong as part of that process. So, again, I'm expecting to see a lot of capital flowing into the Greater Bay Area, and Hong Kong should be a beneficiary of that, would be my guess.
Peter, how do you expect the national security law to play out when it comes to the attractiveness for investment and business in Hong Kong? Because there seems to be a tension, right? There's a number of voices within, the business establishment saying that anything that introduces certainty or removes, these sometimes violent protests from our streets is a good thing for investment confidence. And on the other hand, it's been pretty roundly condemned by major trading partners like the US and the UK.
Yeah, that's absolutely right. I mean, let's face it, most countries around the world have law with regard to national security legislation. And China is no different here. And the law so far, as we have seen it, is talking about punishing or preventing acts of secession, subversion, terrorism, etc. But most significantly, it's also focusing on activities of foreign and external interference in Hong Kong. Now, let's face it, from a business point of view, that could be just about anything. Most foreign organizations and chambers of commerce and trade groups and so on all seek to influence economic and business policy in Hong Kong in one way or another to support their business. So now, is this going to be seen as an act of subversion that business communities seek to direct and change policy with respect to taxes, with respect to rules on allowing businesses to operate and so on? Let's face it, every business chamber of commerce tries to do that. So that is a concern that these kind of activities could be seen as a threat to national security. in a funny kind of way, the U.S. raised the issue of national security over the steel industry, and used that as a weapon against China in threatening to impose conditions on China's exports of steel. So national security was used there in a case of business, and that's what I think the business community gets concerned about.
So we talked about JD and NetEase, for example, but it's becoming increasingly clear that the capital inflows and investment inflows are likely to come from these Chinese companies almost coming home, right? Is there a real concern that we'd like to see a reversal when it comes to, actual foreign investment? And is this kind of the nail in the coffin after what's been almost a year of protests and the economic decline on the macro front?
I don't think so. I mean, if we look at Hong Kong's financial flows over the last 20 years, they've been largely dominated by flows in and out of China and China companies' exports and imports and so on. So it is very largely driven by the China business anyway. What I think is the major risk and the major concern is what you might call the nuclear option. From the U.S. For example, if it blocks Chinese banks from the global dollar clearing system and puts in curbs of that nature, that could be devastating for Hong Kong and for China. But are we likely to see the Americans adopt that kind of policy? It doesn't seem likely at this stage. But that nuclear option is the one that we most fear, and that could be devastating, not just for Hong Kong, but for China generally.
Peter, with several unknowns remaining, both businesses and consumers in the city, people who are attempting to negotiate the potential outcomes here, they're trying to find their backstops, their insurance policies. We're seeing that in the property market. Property prices have remained resilient as people look to this space as a safe investment during these chaotic times. What else are you seeing when it comes to a potential exodus? Are you hearing from businesses, for example, that they're looking to shift their operations and assets?
Well, quite frankly, I think most families and most businesses, for a number of years, facing the trade issues and so on from the U.S. and the slowing economy in China, have been putting in place what you might call insurance policies or a plan B for their personal finances and for their businesses. For example, with the trade war initiated by the U.S. against China, many companies are setting up other manufacturing bases in places like Vietnam, India, Indonesia, Malaysia, Thailand, and so on. And so, of course, to some extent, there will be some drain of expertise and capital from Hong Kong and China to those venues. So I think that's happening anyway, and I'm not sure that we're going to see a massive exodus in this respect. For example, last year, the American Chamber of Commerce did a survey in October, and this was well before the latest security legislation was raised, and something like 50% of the members that replied to that survey had considered moving out of Hong Kong or had made contingency plans to do so. And the recent survey done last week by the American Chamber suggested that 70% of people that answered the survey were not considering relocating, but 30% of them were figuring on some kind of alternative plan B and escape route one way or the other. So I don't see a mass exodus by any means, but I think companies and families and individuals are putting in place a plan B in their insurance policies of one kind or another.